Index fund, mutual fund, ETF, what are those things? In this video, I'm going to break down what they are, what their differences are, and the pros and cons of each. By watching this video, you'll understand these new terms and be able to decide which one's the best for you so that you can grow your money with minimal effort. Stay to the end of the video so you know which one's the best one for you. Yo guys, what's going on? If you're new here, I'm Davis and welcome to my channel. Investing jargon can be confusing and overwhelming when you're first getting into personal finance. When you get set up with your work retirement account, not much is really explained to you. I wish these things were taught to me during in school, but it's never too late to learn. If you're looking into retirement accounts right now, or you've been meaning to, I'll link a video of a 401k versus IRA above and below. What is an index fund? Index fund is a bucket of stocks or assets that represents a specific market. So an index is a way to calculate and measure the performance of a specific market, but you can't actually invest in it. Index fund, on the other hand, is a bucket of stocks or assets that measures and tracks a specific market that you can actually invest in. Stocks or assets are put into this bucket by copying a specific index. There are index funds that track based on different markets, such as geography, say China or India, based on industry, say banking, aviation, or tech, and then also based on assets, cash, or different commodities. An example would be Vanguard's VFIAX. This index fund has the top 500 companies in the US. Examples of companies that would be inside VFIAX would be Apple, Amazon, Google, Nike, Home Depot, and Chipotle. One of the main benefits of investing in index funds is the automatic diversification, since you're not worrying about individual companies and you're just focusing on specific markets such as the US. If one company goes bankrupt, you still have 499 other companies that can build and grow and continue to increase your investments. Another great thing about investing in index funds is the low expense ratios or fees that you have to pay compared to other investments. The reason why the expense ratios are so low is because index funds are passively managed, meaning there's nobody actively managing the portfolio. There doesn't need to be a team to do research to pick the stocks because the index fund is just tracking a specific market. The goal of an index fund is to follow the performance of a specific market. I'm going to make a video on the top index funds that you should invest in, so subscribe so you don't miss out on that video. Alright, now we're going to go over what's a mutual fund. A mutual fund is also a bucket of stocks or other assets. So then what's the difference between a mutual fund and an index fund? The main difference between a mutual fund and an index fund is a mutual fund is actively managed, meaning there's an active fund manager and an investment team that's researching and picking stocks for you. Other difference is the goal of a mutual fund is to try to beat the market. One thing to keep in mind is mutual funds fees compared to index fund fees are much higher because the mutual fund has to pay the active manager and the investment team to do the research of the stocks to try to beat the market. The main benefit and pull for mutual funds for a lot of people is that the mutual fund is trying to beat the market and not trying to just match it, and there's an investment team that's picking stocks for you. The biggest downside to investing in a mutual fund is the high expense ratios. Those expense ratios really eat away at your gains over a long period of time, and there's no guarantee that the mutual fund will even beat the market. You know what an index fund and a mutual fund are. The next thing is an exchange traded fund. First off, an exchange is where stocks or other financial instruments are traded. Exchange traded fund is also a bucket of stocks that follows an index. An ETF is called an exchange traded fund is because it's bought and sold on an exchange just like stocks. The difference of an ETF is that it could be bought and sold throughout the day during market hours compared to index fund and mutual funds which can only be bought and sold once a day. An example of an ETF would be SPDR. This ETF tracks the top 500 companies of the United States. The main difference here is you can buy and sell SPDR throughout the day. If you're interested in investing in ETFs because you can invest in them throughout the day just like stocks, I made a video on things you should do before you invest in stocks. I'll link it up above and then down below in the description. Alright, now that we've gone over index funds, mutual funds, and ETFs, I'm going to do a quick recap so that you can clearly see the similarities and differences. An index fund is a bucket of stocks that represents a market, is passively managed, has low fees, the goal is to match the performance of a market, and can be bought just once a day. A mutual fund is also a bucket of stocks that represents the market, but is actively managed, has higher expense ratios, the goal is to beat the market, and can be bought just once a day. An exchange traded fund, on the other hand, can either be passively managed or actively managed depending on the ETF you choose. The fees will also vary depending on the ETF you choose. And then the goal of the ETF will either be match the market or beat the market. But the biggest difference is you can buy and sell ETFs throughout the day. Alright, after all of that, the one thing that you should strongly consider investing in is index funds because you'll automatically be diversified, you'll pay lower fees, and you'll automatically be able to invest in index funds every single month. The reason why I wouldn't choose mutual funds is because I don't want to pay higher expense ratios, and there's no guarantee that a mutual fund will even beat the market. And historically, index funds have outperformed a majority of mutual funds. Lastly, I wouldn't choose ETFs because I'm more of a passive investor. I'm mostly investing just in my 401k and individual retirement account, so I don't really find a need to be able to trade an ETF throughout the day. Comment down below which fund you'll be interested in investing in. If you made it this far in this video and you found it helpful, click the like button as it'll tell YouTube to share this video out to more people, and it'll help me out a lot. If you're interested in more videos on personal finance and investing, subscribe so you don't miss out on my next video. Thanks for watching. I'll see you guys next week.